Danse, Errol Wilson, the Jitsikazun, Peguis First Nation in Manitoba, Ochinia. I'm the General Manager of Nuichihau Acceptance Limited since August of 2022, just over a year now. Welcome, and thank you for listening in to today. I want to share a short slide presentation to explain the new policy guidelines that will affect all borrowers of Nuichihau acceptance. Nuichihau and NAL are used interchangeably in this presentation. Firstly, I'll give you a brief background of NAL, but the focus of the presentation is the new loan policy guideline that provides an opportunity to write down the accrued interest on all current loans. Then I'll briefly explain some of the new services that we're working on at Nuichihau as well. So a quick background on Nuichihau Acceptance Limited. The company has been operating since 1987, when it was initially capitalized, independently operated, and owned by the Ermiscan Cree Nation. Then in 2017, NAL shares were transferred to the Neasquehannock Group of Companies, NEGCI. So for over 36 years, NAL has provided consumer loans to employees of the Ermiscan Cree Nation. I think the history of Nuichihau is remarkable, and all ECN members can be proud of it. While there are many collectively owned lending corporations across Canada, very few are owned and operated by the individual First Nation. NAL in recent years expanded its services by offering loans to other First Nations that are fully guaranteed. Currently, the human resource at Nuichihau is 3 employees that report to the board of directors and ECN on a quarterly basis. As I mentioned, the focus of this presentation is the new policy guideline that provides an opportunity to write down the accrued interest on all current loans. The policy was approved in August of 2023 by the NAL board, and in September 23 by the Ermiscan Cree Nation. The new policy is termed the 2023 ELF Loan Portfolio Write-Down and Write-Off Policy Framework. The purpose of the policy is threefold. Basically to address the state of the Ermiscan Loan Fund portfolio, recover loan capital, and set a plan to return ELF to sustainable operations and seek growth opportunities for the loan fund. Currently, the loan fund has $6 million in the portfolio, of which 36% or $2.1 million of that $6.4 million loan portfolio are loans that are being repaid on a regular basis. But the reality is 64% or 2/3 or $4.3 million is not being repaid. So besides not earning interest on the loans, the loan principal is also not being recovered for future loans. So as a result, NAL now frequently borrows money to make new loans rather than using reserve cash resources. So the new policy framework is designed to regain and utilize the capital for its intended purpose. The borrower's response to the new policy will give an idea of how much capital is available for future operations and possible expansion plans. So the rationale aligns with the purpose of ELF's new policy rollout. It's really to clean the clean the slate of the ELM loan portfolio and start anew. It's designed to be fair to all borrowers in the portfolio. So let's review the new policy guidelines, which are essentially unchanged from the previous operations, except they will be more closely adhered to. In the past, many loans were made beyond the policy guidelines, creating the current position of the ELF portfolio. I'll outline the three types of loans and the guidelines for all future loans. And those are secured employment loans, which are guaranteed by the employer. Unsecured employment loans, which are not guaranteed by the employer. And then asset secured loans, which are where the borrower actually puts up collateral to secure the loan. The first one is the secured employment loans, and it's really returning back to the original policy guidelines. Maximum loan is based on 10% of the employee's annual income. So if the employee is earning an income of $40,000, the maximum they can borrow is $4,000. The employer secures the 100% of the loan through a guarantee. First-time borrowers must repay the loan within 1 year, and borrowers' payroll deductions, or PRDs, will not exceed 30% of the payroll period. So, and then interest rates are now going to follow the Canadian prime rate plus 2%. So the Canadian prime rate today is 7.2%. In this case, would be 7 plus 2. 7.2 plus 2 would be 9.2%. The second type of loan is the unsecured employment loans, which are similar to the first, except they're just not secured or guaranteed by the employer. And again, the maximum loan is based on 10% of the employee's annual income, and the loan is not secured by the employer. First-time borrowers must pay within 1 year, and borrowers' payroll deductions shall not exceed 30% of their payroll period. And then the interest rate for these loans, because they're higher risk and not guaranteed, are set at Canadian prime plus 5. So 7.2, today's prime plus 5 would be 12.2%. And the final type of loans to be made in the future will be asset secured loans, and this is a new policy guideline. It's secured assets are used to secure the loan and must have a serial number for personal property registration and be transportable for resale should they be realized to pay the loan in default. Secure value is based on the asset's current market value, and will end up to 75% of that asset value. Loan repayment is a maximum. Loan repayment term is based on the useful life of the secured asset, but not to exceed more than 60 months or 5 years. The interest rate will be based on a risk rating matrix, which is really determined by the value of the collateral offered and the borrower's history. Now let's talk about the incentives that are designed to attract past borrowers into paying, and also designed to be fair to borrowers who have diligently paid their loan. Overall, there are some basic parameters. The policy incentives are for all borrowers in the portfolio, but exclude other First Nation loans. The incentives will essentially forgive or write down all the accrued interest to some degree, which really depends on when the loan is repaid in full, and I'll explain it as I go through here. So the borrowers are categorized as ECN paying or ECN non-paying. There are 7 scenarios that will determine how the policy is applied. So the first scenario is ECN paying loans, and basically the policy is forgiving 100% of the secured interest if the loan is fully repaid by March 31st, 2024. So basically 4 months from now. And so the impact to the borrower is that the borrower pays back the loan principal and admin fee only, and future loans are to be made by the guidelines only. The impact to ELF is that they recover 100% of the principal and the admin fee gets repaid, and 0% of the accrued interest is repaid. The second scenario applies to all those to the ECN not paying, and I guess all these apply. This one applies to the non-paying. Sorry. So the incentive is to forgive 90% of the accrued interest if the outstanding loan is repaid by March 31st, 2024. The impact to the borrower is the payback the last loan principal and admin fee plus 10% of accrued interest, and future loans will be made by guidelines only. The impact to ELF is ELF gets the principal back into the portfolio, and the admin fee is repaid, and then 10% of the accrued interest is also repaid to ELF. The next scenario applies to both paying and non-paying members of ECN, and it forgives 75% of the accrued interest if the loan is repaid back by March 31st, 2025, so essentially 16 months from now. So payback, the impact of the borrower is paying back their loan and principal and admin fee plus 25% of the interest. And then the impact to ELF is they get the fund gets back 100% of the principal and the admin fee, and 25% of accrued interest. The fourth scenario applies to paying and non-paying, and this will provide a 50% forgiveness of the accrued interest if the loan is repaid by March 31st, 2026, which is essentially 28 months from now. And again, the impact is the borrower pays back the principal and admin fee plus 50% of the accrued interest if the loan is paid within that time, and the impact to ELF is you get back the initial principal and admin fee plus 50% of the accrued interest. The fifth category is forgives. It applies to paying and non-paying ECN borrowers, forgiving 25% of the accrued interest if the loan is repaid by March 31st, 2025, essentially 5 years. The impact is to the borrower is that they pay back the principal and admin fee plus 75% of the accrued interest. So there is some forgiveness even within the 5 years. The impact to ELF is the 100% of the principal gets returned with the admin fee, and then 75% of the accrued interest. The sixth scenario is for those ECN paying and non-paying who who are not able to pay within those 5 years. So basically, there is no incentive, but is just to be paid as initially agreed in that they would in with principal plus interest until the loan is repaid in full. And the final scenario is applies to all borrowers in the portfolio, and it's those that choose not to participate. And the impact is basically a double negative. It's just the borrower doesn't the borrower is not eligible for future loans. So the impact to the borrower and the impact to ELF is it's 100% write-off of that loan, that those funds are lost and will be written off in the future. So how does that apply to your loan? So I thought I'd throw in a couple of slides in here to provide an example of how the policy would be applied firstly to a paying loan. So let's look at this one here. This particular loan was taken out in November of 2022. It was a $13,523 loan. Payments made to date are $6,600. Accrued interest is $1,342, and if it's paid by March of 2024, 100% will be written off, and the payout balance would be $6,923, which is essentially the principal less the payments made. And with it's been 4 months, so in this particular case would be 4 payments of $1,730, or just one payment of $6,923. So a lot of borrowers will not, in this instance, they're probably not able to pay this. So we'd go to the next time frame, which would be pay off by March 31st, 2025. The last loan and the payments made are the same. The accrued interest increases over time, and the interest write down is 75%. So 75% of 2,096 is 1,572. So the payout of that balance would be 7,447, or monthly payments of $465 over 16 months. And then you're still not able to work that into your budget, then we pay off the loan by March 31st, 2026. Again, the last loan, the last loan or the principal is the same, and the payments are the same. The accrued interest rises to $28.51. The portion of write down is 50%, or $14.25. The payout balance would be $8,348. Take 20, which it could take 28 months of roughly $298 per month to pay that. And finally, the final category to take advantage of the incentive to pay down is paying the loan off within the 5 years, or March 31st, 2028. And the accrued interest rises to $43.61. 25%, or $1,090 is forgiven, and the final payout on that would be $10,194, or 52 monthly payments of $196. And the second example is those in the non-paying loan category. So I'll just go through this one. This loan was taken out back in December of 2009. It was for $34,445. Loan payments made to date, or since that loan, is $31,590. Accrued interest has risen because it's such a long time. It's over 13 years. $30,658. The interest write-down would be 90% of that, or $27,592, and the payout balance would be $5,921.69 if the loan is paid by March 31st, 2024, or 4 payments of $1,480. And then as in the first example, the principal and payments made remain the same. The accrued interest rises as the longer the term of the loan is stretched out. In the case of March 31st of 2025, the accrued interest will be $32,641, and the forgiveness will be 75%, or $24,481, and the payout balance will be $11,016 or $688 over 16 months. So if the loan is paid by March 31st, 2026, again, the principal and loan payments made remains the same. The accrued interest rises to $34,624. The write-down on that accrued interest is 50%, or $17,312. The payout balance would be $20,168, or $720 per month for 28 months. And then finally, in the 5-year category, or March 31st, 2028, the accrued interest will be $38,596, and the forgiveness on that portion will be 25%, or $9,649. So the payout balance will be $31,803, or 52 payments of $611.60. So thank you for your attention to this presentation. Please get in touch with NAL to review your situation and understand fully how it applies to your situation. I hope this encourages many non-paying borrowers to revive their relationship with Nuichihao and be able to grow together in the future. And finally, just one note of the things that are in the works with Nuichihao. We are looking at providing more financial and credit information to credit counseling in both on an individual basis and financial education in group settings. And we're looking at doing partnerships with the Credit Counseling Society and the NGCI Youth Business Services. So really the purpose for this is really to empower our clients to progress beyond NAL's consumer loans with improved financial skills, and then assist the clients in accessing a full range of banking services by improving their skills and financial capacity. So thanks very much for listening to this, and look forward to speaking with you all.